Hey traders, welcome to Charts and Coffee. Happy Wednesday, everybody. We've just got the CPI data, so let's start the conversation with that. Today we had at 8:30 a.m. Eastern, so roughly 30 minutes ago, the core and the CPI. By the way, anytime you see core anything, it just means that the data excluded some of the data points. So this data of as you can see right here, the consumer price index, in the case of the core, they exclude food and energy. So with the data of the CPI, that includes food and energy. I've always found it very funny that there's a number that excludes things like food and energy as if nobody needs them. But their logic is those can be very volatile and they want to have a nice smooth number. My thought is, why not actually reflect what it is that inflation's doing of things that we all actually need and use every day? But hey, that's just me. But what the bottom line is this: whatever we may think of the data and the calculations and sort of the ridiculousness of it all, this is a metric that everyone's going to look at. And in the case of really the question we're all trying to ask is the Federal Reserve going to cut anymore, or are they done? And if they're done, are they going to start hiking? And if so, when? That's always the only macroeconomic concern. All this data is just the stepping stones to answering those questions. Now, if the CPI is cooler, that opens the door to, they might be open to cutting again because the cuts haven't increased CPI, right? That's one way to look at it. Oh my gosh, my dog's back here trying to rearrange my rug. I wish you could see it. What are you doing, puppy? All right, so I don't know if you hear that in the background, but puppy's in the house today. All right, so that's what the CPI says. So if CPI is cooler than expected, if it's a number that's flat, this is where ultimately, this is where the data lands. Are we going to see a cut at the end of this month? No, 97.3%. That is a no. What about next meeting? So we skip February, and because we don't want those Federal Reserve members working too hard, right? So now we skip February, go to the March 19 meeting. It's 70% we continue to hold. It's only 29.2 we cut. So probably not, although there's a lot of data between now and March 19, but based on what we know at this moment, probably not. Things get a little bit more interesting, a little bit more sooner as of the CPI than they were yesterday. So yesterday, May was still a big cup of nope in terms of a rate cut. And now we're starting to see, wait a minute, May is up for grabs, right? May is absolutely up for grabs for a potential rate cut. And then everything after May, every meeting after May is going to have a slightly more dovish looking stance. One more rate cut is definitely something that seems to be priced in by the time we get to the end of summer. So yeah, one more rate cut is not out of the question. Fast forward to the end of the year. Hey, the end of the year says we could get 2, maybe 3. Now I say could. We have to go by probabilities, right? So by December, I'm not trying to guess in January where we will be in December. There are futures contracts for that, right? We have a futures contract, by the way, for the March expiration, right? For September, for December. The futures contracts are always, like their name suggests, looking ahead, right? What we know right now is going to be priced into March, September, or actually I skipped over June, March, June, September, December. And so everything has a sort of forward look, and we take what we know now and we just sort of superimpose it over what we think could happen. Do the equity markets go higher? Do the equity markets go lower? Do interest rates go higher? So these are interesting things we can look at as futures traders, where I could compare the current or front month of bonds to the December contract of bonds and see where traders who are speculating on December's rates, how they differ from where we are now in January. So it's all very cool stuff. And it's just price. It's all price and charts, so we can study these things. And we know that when these data points come out, we make decisions about the implications for, what bonds are doing, what equities are doing now and going forward. And keep that going forward in mind, because as we go into today's trading session, there's a lot more optimism now than there was just, the last 3-4 days. Now, this is where color coding really helps me. So let me talk a little bit about what's on this chart, and everyone can sort of fine tune their perspective. I'm going to grab my drawing tools here. All right. So when I look at this chart, it's really simple. It's just as if who glances into the cockpit when they get on a big plane, right? Who glances and go, wow, what are all those gauges for? The pilots know, and they're not staring at all of them all the time. They know, depending on where they are in the flight checklist and where they are within the life of the flight, they know what to look at. They're not looking at every single one of them. And I'm not even a pilot. That's just common sense, right? Same thing goes for a chart. There are certain places that, I'm going to keep an eye on. For example, my secret squiggle. If I'm wondering if something is oversold or overbought, that's its only job. I'm not constantly looking at it for feedback and it to tell me what to do, right? And that's a price-based, for the most part, a price-based view of, for example, the daily time frame of the S&P. Then I have this V-score. It's a custom indicator, and this is actually looking at volume. It's looking at the standard deviation of volume. This is size, right? What kind of size do we see step in when we get to a +1 standard deviation? Take a look at going back to last year. That's support, right? Again, support. So we're at a level that, not based on price. If you look at prices were at different levels. It doesn't look like it's as steady as it is. But when you look at volume coming in, what's volume? Volume is commitment. Volume is what? It's a spot at which buyers will say, this is where I'm willing to plant my flag, so to speak. So this was a support level based on volume, right? As was this. And I'm just looking at where we hit this +1 standard deviation, that line right there. Right in here was another one, and you can see we're flirting with it again. So even though these are not even price-wise, they're actually even volume-wise. That should also tell us something. So when I want to know about what kind of participation is kicking in at a certain level, I can look at something like a V-score. And then the fact that the candles have been predominantly red since December 18, when Jerome Powell woke up and chose violence. I know that as long as it's mostly red, I'm going to be a little bit more bearish on the daily time frame, or at least very, very cautiously bearish neutral. All right. And these are all things that I'll look at, again, I know what gauge tells me what. So if you're looking at this chart thinking, wrong, that's a lot of information, just know what each thing is telling us. And then it's really easy to go, all right, I'll just go to that section of the chart when I want the feedback on volume or overbought or oversold or whatnot. The other zones that I'll be keeping very close eye on are, of course, my daily price movement ranges. These are volatility-based automatic support and resistance levels. I'm trying to do something that I think all of us are always trying to do when it comes to trading, which is automate, right? It's not that I don't want to think. I don't want subjective thinking having to, what's subjective thinking? Emotions, right? Turn on the television. That's what they're trying to do. They're trying to grab you and get you to be scared 99% of the time, right? So what I want to do is, I'm always the one who's making the decisions about what to do with my money, as we all should be, but I'm trying to automate those things where if emotion and opinion and other things that don't help me with my trading are tempted to creep in, we've got a process-driven reason for every one of these things to be plotting and giving me information. And so what we want to do is just make it as automatic as possible. Sort of like those old paint by numbers, right? I still have to do the painting, but it's there to help me say, hey, put this color here, put this color there. And the outcome is, well, it should look pretty good when I'm done. That's kind of the way I look at the automation of tools on my screen. And if you're not doing that now, ask yourself, how much of my process is sort of feel, right? We don't want any of that. How much of my process is emotion? And how much of my process is what I'm thinking, not what I'm seeing? And the more that we can get rid of feelings and thinking and hoping and wishing and just say, hey, this is what it is, we're going to be able to make better decisions. And better decisions sometimes are just, hey, maybe I don't want to engage in longer term setups on a daily. Maybe I'll be a little bit more nimble on a 5-minute time frame and be a day trader today. And when that's done, maybe I'll realize that there's a lot of stability out on the weekly chart. In fact, for as much volatility as there is on, say, the Dow right now, which on the daily time frame is in a downtrend, interestingly enough, the weekly is in a gorgeous uptrend. It's in a gorgeous uptrend. So if we can look at each time frame as a slice of psychology and not presume they're ever going to agree, the way I feel at 9:20 in the morning might be very different than the way I'm thinking and feeling at 11:01. And at the end of the day, again, it's very different. Charts are the same way, right? So a 5-minute can go through the gamut of emotions, fear, greed, whatever, throughout the day multiple times, while the daily is going to be comparatively much more stoic, and the weekly is going to be practically glacial. So if we start to think about each time frame as a specific slice of psychology, and I will say, I don't use multiple time frame confirmation for that reason. The 5-minute is not always going to agree with the daily. However, if you look at the daily and say, Rog, it looks kind of heavy, I'd rather be a short-term bear. That's fine. That's fine. But then look at today, right? The daily time frame of the Dow is in a downtrend, but the 5-minute chart, a completely different slice of psychology, is in an uptrend, right? And these are things that we go over daily to make decisions in the Sector Secrets Mastery. And then I send out an alert, right? You're not left on your own. Say, hey, this is what I see. This is why I see it, because everybody needs to be able to understand the foundation of the trading idea. Otherwise, how can you take it, right? Confidence does come from a certain amount of confirmation and just comprehension, right? Yes, I love alliteration. But if I don't explain the why, then the brain's going to go, I don't get what I'm doing. And consequently, it won't do it. So yeah, 5-minute time frame, I'm a bull, right? If you say, Rog, what's your sentiment on the 5-minute time frame? It's bullish. Rog, what's your sentiment on the daily time frame? It's bearish. They don't have to agree, and they won't often do so. All right. So let's get to any questions that y'all might have. And let's see. GR, good morning. Thanks for yet another great video, Choppy Market Game Plan. Any chance of recording a specific video on tips for trading a down market? GR, I'll tell you, a down market is basically, instead of buy the dip, it's short the rip. And that might seem really simple. And that's just the first sort of volley into this conversation. The next one is, do we really want to trade downtrends? I'll tell y'all straight up. Okay, we had 2 swings this week. This is only Wednesday, so 2 trading days. We had 2 swings this week, 2 alerts that I sent out. One was taking advantage of a downtrend. I'm going to be straight up with you. I don't like bearish markets, and I'll tell you why in a moment. But one was a long put setup in the industrials, and the other is a long call setup in airlines. Airlines are going to continue to be an outperformer. I had to take a small loss, and it was a small loss. It's a little larger than I would have liked, but it wasn't a complete max debit 100% loss, not in any way. It was still a small amount of my account, not a giant amount. What's small, by the way? Habitually, traders will risk 5, 10 or percent or more of their account. So if you have a $10,000 account and you're risking $1,000 of it, that is a absolutely disastrous trading plan. I see it happen all the time. Don't do it. If you've got 10,000 and on a particular trade, if you could lose $1,000, if that's in the plan, that's 10% of the account. That is absolutely unscalable. All right. In the case of what we're talking about 2, 3, 4%, sometimes even less. So think about what you're risking of your account. So I took a loss in XLI, and we've still got the long position in airlines going. The reason I do not like downtrends is because there is absolutely, people ask me all the time, is the market rigged? Yeah, it is, to the upside. That's the only thing. The market is rigged to the upside. It is, if you look at a logarithmic chart of 100 years of the indices, pick any one that you'd like. Generally speaking, they're moving higher. Look at 100 years of the S&P or of the Dow. They just generally move higher. Think about every rebalancing or reconstitution of an index. What are they doing? They're getting rid of underperforming names and putting in outperforming names and usually weighting them even more. So the constant evolution of the equity markets is to have the best in that group of NASDAQ 100 or Dow 30 or Russell 2000 or S&P 500, to have the best 500 stocks in there. So yeah, it's naturally going to continue to climb. The other thing is as well, central banks since '08 and most definitely since 2020 have not even in any way shied away from stepping in with their massive powers to support the equity markets. Case in point, during 2020, the Federal Reserve, the Treasury, they empowered the government basically to buy HYG and JNK ETF, which is high yield and junk ETF. Why would they do that? Doesn't matter why, doesn't matter whether they should. There's a lot of questions about that, but that's ancient history. The fact is they did, right? They stepped in. When Jerome Powell back in 2019, Q1, saw that his actions in 2018 Q4 were out of alignment with expectations on rates, he hiked when largely the broader averages had baked in expected no action. He hiked. And in Q1, we had one of the swiftest sell-offs at that time, this is pre-pandemic, in history. What did he do? He changed his mind. So if anyone's wondering, are downtrends tradable? Yes, but they're not as easy to trade as uptrends. They're far more violent. They're susceptible to short squeezes, and they're usually far less in time. Like, I can't remember the last time we had a downtrend for a year. We had an uptrend for a year last year. So they're very brief. And those are all the reasons where if anyone wants to be a bear, I would say, is there some benefit in saying, well, money doesn't go under the mattress. It's got to go somewhere. That money will flow somewhere. Maybe I'll find where the trend is. I would say, largely speaking, for most traders, either be looking for dips to buy or be flat, or find where the flow is going and grab that uptrend. Downtrends are really tough to trade. And I wouldn't have said this to you all before '08. Before '08, I actually loved downtrends. Gravity was great. Gravity, we have now absolutely broken market gravity. I say we, central banks globally have broken market gravity. Before '08, downtrends were viable. I think since '08 and certainly since 2020, it's far, far, far more difficult. And that's just, and there's so much allure. There are books dedicated to traders who took advantage of crashes, and there's all sorts of market lore and movies now, but the fact of the matter is the vast majority of us mere mortals, are going to do better in an uptrend. So let's ditch all the, so-and-so in 1987 made this much money in the crash. And obviously we have books and movies dedicated to 2008, but really, the thing that all of us want is 2020. The things that all of us want was Q1 of 2024. That's going to be the best type of trading. Downtrends are not what they used to be. And therefore, they're far more violent. They can be traded, and it's just basically short the rip. I mean, that's really what it is. But I want to make sure I also caution everybody from thinking they're equal. Oh, it's either trending higher or trending lower. We'll just, reverse the strategy by puts on rips versus calls on dips. Not quite that straightforward. All right, PLTR. Is there going to be a rally on? Everything's rallying right now. Yeah, I mean, you can look at the pre-market. It's up just below 69. As a day trade, it might be interesting, but it's really heavy on the daily. Remember, gang, we're going to wake up to gaps, because what happened at 8:30 gets factored in as a gap because the cash open is 9:30 to 4. So we're going to see a gap. There's a pre-market, right? You can see the PLTR on the far left. We can see it went from 66.5 to almost 69. Lots of things are going to do that because of this CPI data. That's all pre-market. It's going to look like a gap on the open, and then we'll have to see what kind of setup we get from there. All right. So again, look, whether or not we like it, it doesn't matter. This is how the markets behave. They are skewed to the upside. They like accommodative monetary policy. Cuts are obviously bullish, and the anticipation of cuts is actually more bullish than the getting of cuts. Right? This is what we saw all year last year. Very naturally, our watch list should be less. Our activity should be less. Please don't press forward in January like you might have been in November. And if you need help with these kinds of ideas, you're thinking, Rob, this makes sense. I just haven't put all the pieces together. I'm not connecting all the dots. Stay tuned, because in just less than a month, I'm going to be doing a webinar on not just 2024, but we're going to be able to include some of this macroeconomic shift that we've seen in January. I'm going to walk you through what we're doing in the Sector Secrets Mastery, and hopefully a lot of you will be able to benefit from what we do in that webinar, and then the immersion that's going to be coming up in the Sector Secrets Mastery for the next 3 months after that webinar. We're super excited about it. The timing couldn't be better, and we'll be able to just kind of let the January melee, just sort of sort itself out, and then move into the rest of the year with a really great game plan. Stoked for that. All right, gang, be good to each other. I'll see you tomorrow. Same time, same station. Pencil into your calendars, February 12th. All right, gang, we're going to have that webinar at 8 p.m. Okay, until then.